Hello there everyone. Today's video we're going to take a look at buying a commercial building within a pension fund. So let's consider the example. I've got a trading company, been trading nicely for many years, husband and wife, directors, shareholders, and they have been renting the premises from which they trade from for quite a long time. And they get an offer from the landlord to say, you know what, I will finally sell the business premises to you. Let's assume they've been trying to get hold of these premises for a long time. They don't want to move. They don't want to buy separate. They want to be in that location. And the landlord said, right, I'm going to sell you the commercial unit. So what do? How do they buy it? In what entity do they buy the commercial building? So one of the ways to do it is via a pension fund. So here's a pension fund. Husband and wife. Now, technically, you don't have joint pension funds for husbands and wife. No such thing. Husband has a pension fund, wife has a pension fund. And technically, those pension funds can own fractions of assets. So you could have half a building in the husband's pension fund and half a building in the wife's. But for illustration purposes, we'll just assume it's one pension pot. So you've got the pension. Now, obviously, you want to buy an asset within the pension, you have to have some cash in there. You have to fund it. There's got to be something in there. So you fund it via means of what we call corporate pension contributions. So the company makes pension contributions into the pension, and that is tax deductible. Tax relief for the company. So take an example, £100,000 pension contribution will knock £19,000, off the corporation tax bill, tax relief at 19%. So the money funded from the company, tax relief on the contributions on the way into the pension, then you accumulate a cash pot within the pension. The pension rules say that a fund can borrow up to 50% of its value. So let's take an example. Let's say the building costs 300,000. The landlord says, I'll do you a deal, 300 grand, the building is yours. Right. You need 200 grand of cash in that pension fund. And then the pension fund can borrow 50% of its value, i.e. £100,000. So 200 grand in cash, borrow 50%, which is 100,000, then you've got your £300,000 purchase price. Now, commercial lenders will give a mortgage, a loan to a pension fund, similar to the will for limited companies or individuals. Not uncommon for pension funds to take out loans. So the rule is that they can only gear up no more than 50% of their value. Hence why on this building costing 300 grand, we had to have had 200 grand of cash to start with. And then you just kind of work backwards, because if, let's say, the cost of the building was only 200,000, then you'd need about 130,000 there or thereabouts of cash. Half of that, 65, that gets you to the 200 grand. So it's all about the borrowing requirements and the cash going into the company. Now, the cash leaving the company into the pension fund. So building is bought in the pension fund. And of course, the rent that was being paid for years to the third-party landlord is now paid to the pension, which is owned by the husband and wife. So it's basically paying money from their company to their pension. Now that, of course, continues to attract tax relief in the same way it did previously when the rent was going off to a third-party landlord. So you're still getting tax relief on the rental payments, and the company reduces corporation tax. You can continue to make pension contributions even after the building has been bought. Nothing to stop you continuing to put money in to these pensions, to buy other assets, stocks and shares, bonds. Now remember, the lifetime limits for pensions, £1 million each for the husband and the wife. So that's 2 million that they've got in their before they retire, before they crystallise the benefits to potentially fund. So the 300,000 of the property can only just be the start, really. There's plenty of scope to put more in down the line, assuming they're going to be trading for several more years. So it's a great way to save on corporation tax, because you're getting tax relief on the rents, tax relief on pension contributions, and of course on the flip side, the pension pot that's receiving the rent and the pension contributions doesn't pay any tax on receipt of those funds. So The pension contribution, in terms of how quick you can fund the initial purchase of the building, well, the rules say that everyone can have £40,000 a year that they can put into a pension. However, if you haven't used the previous 3 years worth of £40,000, then potentially in this current year, you can use those as well. So technically, you could quadruple up. You could put in £160,000 each from the limited company. Cash restrictions, of course, cash constraints have to apply. You don't want to decimate your working capital. But in theory, you could get all that money into the pension as soon as possible. And in that scenario, even if there, let's say there was hundreds of thousands of pounds of cash sat in the balance sheet of the Tradeco, the building can be bought straight away without even the need for gearing to borrow. But that example just showed you that there are rules around borrowing, and it is possible to take a mortgage out in a pension fund. But yeah, the actual amount and how quickly it can be funded will depend on your contribution history. How much have you put into pension previously? And it doesn't have to be this pension. It can be another pension that you've already got set up. Indeed, one of the ways that you could do it, you could cash in existing pensions. So this just assumes there's a new pension set up. You could cash in an existing pension that's been there for years, that's maybe just invested on the stock market, several £100,000. You say, you know what, we're going to just liquidate that. That is tax free. When you liquidate assets within a pension fund, you're just swapping one asset class for cash, and then with the cash, you go and buy the commercial building. So there's all sorts of opportunities, but I would seriously suggest that if you are considering buying a commercial unit, and it doesn't have to be the one that you're trading out of, you might just for an investment purposes, nothing, tenants, nothing to do with your business, but just buying a commercial building, commercial unit anyway, have a look at the pension route because of all the tax efficiencies that I've talked about. So if you like this video, please do subscribe right there. And as always,